Mortgage rates are falling at the fastest rate in 4 decades, which is creating a shakeup in the housing market. Then this morning, we had Macys release their earnings report, and what they said is that they expect bigger profits because more rich people are shopping at Macys. And then you had Jamie Dimon, who is the CEO of JP Morgan Chase Bank, come out and say that he thinks that we're going to enter a recession in the second half of 2023, but he says it's going to be a mild recession. What he's saying is he's predicting it to be a Category 1 hurricane. So let's jump right in, starting with the mortgage story. Today is Thursday, November 17th. So mortgage rates are dropping, even though the Federal Reserve Bank has been raising interest rates, which is creating a shakeup in the housing market. And this is one of the reasons why I always say it is so important to actually read the raw data and not just get an opinion based off of headlines, because after the report came out that mortgage rates have been falling, here's what CNBC put in their headline. The headline is, "Sharp drop in mortgage rates does little to boost demand." Then Yahoo Finance, around the same time, this is like within an hour, put out another article which is titled, "Homebuyers Race to Capture Recent Drop in Mortgage Rates." So what are mortgage rates doing to the housing market? Well, we can make predictions because typically when you lower mortgage rates, more people will want to buy homes, but we're not going to know until the data actually comes out, which is why you don't want to just make your decisions or opinions based off of headlines. Headlines mean nothing. The data is where the actual analysis is. So make sure you actually read the raw data or join something like Market Briefs. So that's what's going on with mortgage rates. If you want to know why mortgage rates are falling when interest rates are going up, let me know in the comments. If people want to get that in-depth analysis, I'll make a video and release it tomorrow morning, Friday. So if that's something you're interested in, just let me know. Second has to do with Macys. And the reason why I wanted to cover Macys is because, not just because of what Macys said, but because of what it kind of implies on the broader market. So Macys released the earnings earlier today on Thursday, and they said that they are seeing a better than expected profit because their luxury sales have been doing very well, because higher income earners are going to Macys and they're shopping for social events after the pandemic, and they're splurging at Macys. But at the same time, Kohl's came out and they also gave their earnings report, and what they said was a little bit different. Kohl's, who caters more towards middle-class Americans, says that they are struggling because middle-class Americans don't have money to continue shopping. And this comes at an interesting time because if you remember, earlier this week I talked about Walmart. Walmart says the reason why the profits are beating expectations is because they have more and more rich people shopping at Walmart. Macys, very similar story. They're seeing better than expected profits because more and more rich people are shopping at Macys. So you're seeing people with higher incomes continue to spend, but they're changing where they spend. Walmart said that they're seeing a huge influx of people making over $100,000 a year shop there. And it seems like you have people who maybe would have gone to, what are the higher end stores? I don't know, Bloomingdale's maybe, or Nordstrom, or whatever those higher end stores are. Instead of going there, now they're shopping at Macys. So it gives you some interesting insight as to what's kind of happening with the shopping and spending, because people are struggling, but they're shopping in different ways and they're changing their shopping patterns, which is affecting companies in different ways. And this brings me now to the third story, which is the Jamie Dimon JP Morgan prediction on the 2023 recession. So earlier this year in 2022, Jamie Dimon came out and he talked about how he expects a hurricane in 2023 without much context. And what he said then was, we don't know how bad this economic hurricane is going to be. We don't know if it's going to be a Category 5 storm or a Category 1 storm. Well, today, on Thursday, November 17th, he did clarify. He says that he expects it to be a Category 1 economic hurricane, because the reason why he's saying it's Category 1, not something more severe, is because according to him, inflation is trending downwards. And because inflation is trending downwards, the Fed is winning the fight on inflation. And so it is going to get better, or it's going to get worse, but not as worse as what many people are predicting, according to Jamie Dimon. Now, what does this mean for you? Well, the Federal Reserve Bank is still planning on raising interest rates. The Federal Reserve Bank yesterday, actually, they had some people gave a statement on CNBC who said, don't expect us to start cutting rates. Don't expect us to stop raising rates. We're going to continue raising rates. So you can expect more interest rate hikes. You can expect an interest rate hike in December, and you can expect more interest rate hikes in 2023. The question is, how many and how aggressive are they going to be? And that's going to depend on what's going to happen with the economy, and that's going to depend on inflation. If our next month's, December's inflation numbers continue to come in lower than expected, they continue to improve, then that's going to be more fuel for the Federal Reserve Bank not to raise interest rates as aggressively. But if we get a surprise bump in inflation, then they can go the other way. And when the Federal Reserve spokesperson went on to CNBC, what they said was, we haven't made a significant enough impact on inflation yet, which is a good thing to say because many people have been celebrating the 7.7% inflation that we have right now, but 7.7% inflation is still extremely high. And so this is where you want to understand that higher interest rates are still coming, and the higher interest rates will have an absorption time for it to actually be absorbed in the economy, because it takes time for our economy to get absorbed with these higher interest rates, which will affect companies. It will make operating businesses more expensive. It will cause more startups to shut down. That is a fact. When you raise interest rates, startups have a tougher time raising money. And if a startup cannot raise more money, they will be forced to either get acquired or get shut down. So you can expect more businesses, more startups to shut down as you raise interest rates. Eventually, it will make borrowing money, like mortgages, even more expensive, your car payment more expensive, and variable interest rate debt for consumers more expensive, along with business debt and your government debt. So that's what's going on today on Thursday, November 17th. Hope you enjoyed more videos like this. And as always, keep hustling.